Let's get started. Welcome to another one of our DEC lectures. As you know, this year we decided that this lecture series is going to be entirely made up of women. Women who are leaders in their fields and making significant impact, contributing to evidence-based policy making. So I'm very happy we have Dina Pomerantz here with us as our speaker. Dina is a professor at the University of Zurich, and before that she was at Harvard Business School. And her research focuses on public policies in developing countries, in particular the area of taxation, and this is what her lecture today is going to be about. So taxation, as you all know, is a big challenge in developing countries where there is often significant informality, and enforcing compliance with tax obligations is difficult because of capacity issues. But resource mobilization is essential for the state to be able to deliver on its public services. So I'm really looking forward to learning from Dina. So,
thank you so much.
Go ahead.
Well, thank you very much for the invitation. I'm very excited to be here. Also a bit nervous with this very high-level audience, so I hope to not embarrass myself too much here. But I'm going to talk about a topic that many of you in this room probably know much better than I do. It's about raising money for the state and challenges in taxation in developing countries. So those of you who are in the room probably don't need to be convinced that taxation is important, and we just heard a great introduction about the relevance of that. But when I talk to people in general, tell them, you know, I study international development, people are very excited, that sounds great, so what are you studying? And then I say tax, and then they're much less excited suddenly. And so the feeling is kind of, but we have all these pressing needs in poverty and emergencies and famines and education and healthcare needs. Like, who has time to worry about taxes? So I try to convince those of you who are not yet sure whether taxation is an exciting topic that actually we should care about it. It is very exciting because, in a way, it's like the foundation of all these other areas. So to execute all its role, I'm standing in the wrong place.
Sorry, no, you're fine. You're fine. I'm just gonna do. There you go.
Thank you. Mm-hmm. So to execute all its various roles, the state needs to collect taxation. So in the long run, no state can exist without being able to effectively collect taxes, unless the state is going to be dependent on oil forever, which, as we all know, is going to run out eventually, or aid, which we all hope it's not going to be the long run for any country. So just taking a step back a little bit, rich countries today also only acquired the capacity to raise money at a large scale quite recently. So if we're thinking about a typical state, maybe Europe where I live, you know, there's like a big social state, there is a big infrastructure, there are big programs, a lot of regulation, and 100 years ago, states weren't able to provide all that, and states weren't able to collect all that taxes. So in this picture, you see the share of taxes in GDP for 4 countries, France, Sweden, UK, and the US. And if you see, it's hard to see the small numbers, but sort of where it starts to incline, it's about the 1920s. And at that time, tax collection as a share of GDP in today's rich countries were actually similar as a share of GDP as in the poorest countries today, so around 10% of GDP. So it's not a trivial achievement. And if you look cross-country today, we see that, you know, more or less in the poorer regions, the tax collection as a share of GDP tends to be lower. Obviously, it's not a one-to-one relationship. You see, within similar income groups, there's quite a heterogeneity, but as a general tendency, that's correct. And if you think about what that means, so these are countries who have already a much lower GDP per person, and now the share of that that's been collected as tax is lower. So the actual resources for the government are sort of twice, from 2 dimensions, lower. So for those reasons, there's been a lot of conversation in many developing countries about how can the state increase its capacity to collect resources. There's many reasons for that. one aspect is what I just talked about, funding for public infrastructure, public services. There's other areas, though. There's state building. There's a very exciting new paper from the DRC that actually experimentally shows what people have thought for a long time, which is that collecting taxes may change the relationship of citizens with the state and may empower citizens to have more demands on the state in return and complain when something's not working because they feel they have an ownership stake. So there's maybe sort of nation-state building aspects that governments want to achieve with that as well. And then there's a very classical economic aspect where, sometimes I talk about, reducing tax evasion. Somebody will say, well, tax evasion is great because I love a small government. But even if you love a small government and you don't think the share of taxes in GDP should grow, you would still be concerned about distortions that can emerge in economies when there are some part of the economy that is taxed quite heavily because it's a small part that has to carry the whole burden. And there are other parts of the economy that effectively escape taxation through evasion that can lead to quite large distortions of resources towards sectors that are harder to tax, but are not necessarily the ones that will promote most economic growth. And finally, governments and countries want to be more and more independent of international aid and be able to sort of stand up to maybe international pressures, and that's another reason why being able to collect one's own resources is often a key priority. So if we're talking about aid, I just want to get a sense from the room. I don't know if people have any idea. So how does tax actually compare to aid currently? So if we're thinking about low-income countries, I'm going to take a vote in a minute. So who thinks, I'm going to read the three options. So tax revenues are much lower currently in low-income countries than official development assistance? Or do you think they're like roughly in the same ballpark? Or do you think tax revenues are much higher? So who thinks tax revenues are much lower than aid? 7, 8 people. Who thinks roughly similar? About 3 times more. Who thinks tax is higher? I think that's the majority. It's almost equal to the P. Okay, so correct answer for low-income countries, they are roughly similar, even though, well, I don't know if this is measured with enough precision to be able to say. Maybe taxes is a little bit higher than official development assistance, but they're similar. So, okay, so then we're saying, good, 2 things, both very important, great. But then what happens when you go to middle-income countries? So there's no comparison anymore. So taxes are way, way more important as a resource for funding the government than official development assistance. So as states grow economically, 2 things happen. Well, both aid tends to fall and tax collection tends to rise. And so the relationship changes a lot. One thing to keep in mind, I think also Rohini Pandey said this earlier this year when she's having the DEC lecture here, that it's very important also then in the phase where aid is a big part compared to taxes, that aid is not structured in a way that actually undermines the state's capacity to collect taxes by bypassing the state, because maybe in the short run it's more convenient, but then in the medium run the state doesn't grow the capability to raise the taxes, and then once it gets to a phase where less aid is flowing, there may be big challenges ahead. Okay, so within all the different problems that the tax collection may have, I'm going to focus on one particular aspect, which is information. So essentially, a big part of what it means to be able to collect taxes is an information extraction problem. So how can the government know which activity in the economy are actually occurring that are subject to taxation? This is particularly challenging in less developed economies because, as you know, there's much more informal activity, both because some firms may not be formal, but also with informal firms there are informal transactions and much less information for the government about the taxable transactions. And again, we don't have to go to the current developing world to see that problem. This was the status of the situation around the world for most of humanity. So here's an example from Denmark. So one of the main reasons that taxes was mostly tariffs, or to a very significant part tariffs for a long time, is that information extraction problem. So in Denmark, for example, there were the so-called sound dues, so Sunset River. where you can see the ships passing here, right, in the picture, and it's hard to hide a ship. So the government can tell somebody is shipping by, and they had a fee that you had to pay every time you passed, and that actually made up 2/3 of the Danish tax revenue, just that one tax for sort of tariff for passing with the boat. By the way, it's has nothing to do with the rest, but it's a very funny anecdote that I thought. They had this very smart system where in the beginning they taxed you going by with a ship, and because that's the easy part to observe. And then they changed to actually having you have to pay a percentage of the value of your products on the ship, and that way they could raise much more money. But the information extraction problem then again was like, how do I measure the value of this shipment? And what they came up with is they said you have to say how much it's worth, and then you either pay the tax or we have the right to buy it from you at that price. So incentive compatibility apparently was already several hundred years ago in use. So today we still see this type of information, different access to information affecting the structures of taxation in many developing countries. So Gordon Lee had this paper that actually inspired a lot of the brainstorming that I did around my project during the PhD, where they say that you can explain a lot of the puzzles of the structure of taxation in developing countries by where it's easier for the government to get information. So you see, this is from the OECD. This is the most it goes, I think, to 2015 or 16. And it's not the whole world. It's 36 OECD countries and 44 non-OECD. But I guess it's still suggestive. And you can see that tariffs, for example, are still a much higher share in developing countries of tax collection than in OECD countries. And also, Jules Remrod and Wojciech Kopczuk have some papers where they show really how it's easier to tax the firm because there's fewer firms. It's easier to monitor firms than all the individuals. So we see that both in that the personal income tax has a much smaller role to play in developing countries, and on the other hand, tax on goods and services such as the VAT play a much more important role. So one potential solution to fill this need for information, except, if you want to get away from just tariffs and ships and visible things and big buildings to tax, is to try to get people to tell on each other. So it's this so-called third-party reporting, where a third party in the economy has an incentive to report to the government about some tax obligations that I have. So this is so-called paper trail. Nowadays it's maybe an electronic trail sometimes. But there's some proof somewhere about something I did that is subject to tax. So an example that many people here know, so if you're in the United States, but in many other countries, similar thing, and you have a salary, then your employer, if they want to deduct that cost from their profit tax, they have to inform the government about the salary they paid you. It's called a W-2 form in the United States. And so the government has all these W-2 forms that say, who has what income. And if I receive a W-2 form, but then I tell the government, I'm sorry, it was a bad year, I didn't have any income, government can come and say, hey, no, but look, here we have proof that you had income, so I can't just pretend to have no income. So here the employer has an incentive to inform about my income because it helps them in their taxes. So that's the idea of this third-party reporting and these paper trails that are supposed to really help in the collection of information. So there's been a really growing body of research in that area. It's a very exciting area. It started with lab experiments, and then all over the world there's more and more papers. I'm going to talk about two that I did in that area that are showing both sort of the potential and some of the limitations of this paper trail and third-party reporting to help with tax collection. I was just saying that. So we have in Chile, there is a project with the Chilean Tax Authority. The paper is called No Taxation Without Information, and it's really showing how the role of the paper trail and third-party reporting in the value-added tax. And then we have as a policy paper as a side product that I'm going to talk to you a little bit about, since policy audience, finally someone cares. And then in Ecuador, we show what happens when they introduce the use of this third-party reporting, and they ran into some limitations that were not all expected, and that maybe there are some lessons there to learn for other countries as they aspire to become as effective as tax collection as Chile is today. Okay, so I've been working with the Chilean Tax Authority for a very long time, So we started in 2008 for a pilot. So one of the things with these randomized field experiments, they're really great, but they take sometimes a very long time. But I think I have a lot of conversations with the team at the Tax Authority, and we both feel like there was a lot of mutual learning going on in addition to the actual paper, which is probably one of the reasons why we keep collaborating still. Because of this very close collaboration that is required to do these field experiments, I also feel that more information is flowing back and forth than if I had, for example, just done some data analysis from existing data. But really, this is due to this very pioneering research department at the Chilean Tax Authority. It has a long history of being very focused on innovation and learning. They were very supportive to do this. And we really sat down for many days and brainstormed ideas like what would be a topic of mutual interest that would be academically interesting, sort of generalizable beyond Chile, but also have tangible, direct, and immediate benefits for them. In part, there was just additional tax collected as we went doing this, so that's already immediately great. And then there were some learnings that were also immediately useful, specifically for the Chile case, in addition to the general learnings. Just really want to thank the whole team. Some of them still at the Tax Authority, and we're still working together. Some of them are in other departments, in other government agencies, and we continue working together there. But it's none of this, actually, the people you see in the picture, none of the things I'm going to tell you about today would have happened if they wouldn't have been somehow excited to talk to a little grad student way back and said, let's find something to do together. Really big thanks to all of them. So what did we do? So we ended up doing 2 randomized field experiments where we varied the firm's perception of audit risk. So it was interesting at the time. Taxes was sort of one of these areas that were thought of to be a key example of why randomized experiments have limitations, and they still do, but it was sort of thought that taxes was an area that were really not prone to randomization, because tax law is the tax law, and you can't just randomly have different laws for different people, obviously. But there are certain aspects, especially of tax administration, that are actually completely at the discretion of the government, where government has to make some choices anyway. Where do we do which intervention? We're not going to audit everyone. We're not going to contact everyone. So it's actually very prone, very practical to test out different aspects. And one of the things that the government can obviously choose freely how to do it is how they communicate with different taxpayers and what their different audit risks are. And so the Tax Authority informed taxpayers about extra audit scrutiny, and then we could observe how their tax payments responded. This is another area for those of you who are sort of thinking about potentially doing research in this area. One thing that's nice is that a lot of the outcomes, we have the data already. Like the Tax Authority collects data on taxes. That's you just talked about the importance of information. And so we didn't actually have to do a survey. So there was no additional cost in that sense. We just could measure the outcome in the day-to-day activities that the Tax Authority does anyway. So what we found is that taxes that are equivalent in sort of standard textbook models of taxation, like the VAT, value-added tax, compared to the sales tax, actually can differ quite substantially in their impacts or in their facility of collection when you think about tax administration and not just incidents given perfect information. So let me give you a bit of a background on the value-added tax. So there was this so-called self-enforcing mechanism of the value-added tax that we wanted to test. And the idea is, and I'll tell you more exactly how in a minute, but the idea is exactly that in the value-added tax there is this built-in structure of incentives for third-party reporting, the way I was describing with the employer and their employee, but between firms, that are supposedly helping the government in collecting information and taxes. And this was part of the argument that had contributed to this huge rise in adoption of the value-added tax from 47 countries in 1990 to almost, almost all countries, I would say, a very vast majority of the countries today, United States being the biggest exception, but there are also some small countries that don't have the value-added tax. And also in many developing countries, it's actually the largest tax. So Europe has lots of places have value-added tax where it's a smaller part of the tax revenue, but in Chile, for example, it's half of tax revenue, and that's not atypical. Many middle-income countries have that as their biggest tax. But the effectiveness at the time of this self-enforcement mechanism was quite unclear because a lot of the evidence was sort of cross-country comparisons. When countries adopted the VAT, tax collection went up, but then there was probably a particular reason. They decided to revamp their tax system, and they often changed many other things at the same time. So it was quite difficult to understand, is it really because of the VAT that tax collection went up, or did tax collection go up because they did a bunch of other things, among other things, the VAT. So in this paper, we really tried to test empirically the relevance of this self-enforcement in the value-added tax. And we found, indeed, that in Chile, there were very strong evidence of these self-enforcing properties, and that the paper trail did lead to large spillovers of tax enforcement along the supply chain. So how does this work, and what is the supply chain, and what does it have to do with taxes? So the value-added tax is equivalent to a sales tax, except instead of it at the very end of the production, the final consumer pays a certain % of the tax on the final product. Every firm in the production chain pays a part of that. And then they can deduct what has already been paid by their supplier. So what that means in practice is that you pay taxes on your sales minus your input costs, right? And so if you want to cheat on that, if you want to evade the tax, you would either underreport your sales or over-report your input costs, and you have too many deductions. But this is becoming really hard now in the VAT because there's a paper trail. So a downstream firm, so if in this picture here, you see like firm 3 would have an incentive to ask firm 2 for a receipt. Say, if I were firm 2 and I want to pay the value-added tax and I want to deduct input costs from firm 2, then I'm going to ask firm 2 for a receipt so that I can make the deduction. So now there's proof in my books that firm 3 had a sale, right? And now, sorry, that firm 2 had a sale. And firm 2 similarly has an incentive to ask firm 1 for a receipt. And so up the chain, we're all asking each other for receipts, and we all have in our books proof that somebody else had a sale. Now, this, importantly, breaks down at the last stage with the final consumer, because the final consumer, not having to pay VAT, doesn't need any deductions, is not going to ask for a receipt, and so that's still the weak spot of the value-added tax. And there's interesting work going on to try to incentivize actually the consumer also to ask for a receipt. Joana Naritomi has a paper on Brazil. A lot of countries have done lotteries and a lot of different things, fines if you don't ask for a receipt, but to try to get at that weak spot. In Chile at the time, there was no incentive for the final consumer, and so we could really use that differential for the test. So yeah, so here, you have the value-added tax chain between firms, the blue part, and then it breaks down with the final consumer. Okay, so we did 2 experiments, as I said. The first experiment was really nationwide and was aimed to test in general equilibrium. This tax has been in place for a long time. Chile was actually one of the early countries to adopt the VAT. Do we find that this paper trail, where it exists, has some power? So does it act as a substitute for the audit probability? And so the government doesn't have to go audit this as much because there's already this self-enforcing property. And so what we did is we tested where an increase in tax enforcement had less of an effect where self-enforcement was present, so between firms, compared to where it was not present with the sales to the final consumer. So the government sent 100,000 letters to firms saying that they had been randomly selected for a special scrutiny. So that we would like to inform you that in a process of random selection among small and medium-sized firms, your firm has been selected for an analysis. And if any irregularities are detected, you could be summoned for an audit. I know there's a lot of discussion about ethics in randomized trial. I think this is exactly an example where we were thinking a lot about that. So I had in mind my dad and what would happen to him if he got a letter from the tax authority that would say, you have been selected for a special scrutiny, and what that would do to the quality of his sleep. And I felt like we can't do that to 100,000 firm owners, so that we explicitly said randomly selected, because in the pre-test we noticed that a lot of firms asked, like, why? And if you tell you it's random, you can sleep well and you know it's random. So that was part of, we had that wording. Which, by the way, as a side note, I think it was really important to this project that we spent a lot of time pre-testing these messages. So we didn't just go and send out a bunch of things and see what happens, but I spent, I think, 3 weeks with in the tax offices asking people, like, if you were to receive a letter like this, what would you think? What would you feel? What would you do? Who would you talk to? And then we changed the wording until the message said what we actually intended it to say. So I'm a big fan of pre-testing everything. So the idea was that we would then see whether firms would respond different that same firm with the same letter when the letter was when the transaction was between two firms compared to the transaction between the firm and the final consumer where the self-enforcement was not present. And so the first part for this to work was that people would actually take the letter seriously. So apparently they did, which is, we'll come with the Ecuador case to that point. It's very important that the tax authority has a deterrence power, that when you get mail from the tax authority that you do lose a little bit of sleep, right? Enough sleep to at least change your behavior. And so we see here that, on the other hand, it's not the case that Chile has zero evasion, because apparently when the government comes calling, suddenly sales go up. So we see a clear jump at the time the letters arrived. And then the question is, does this additional tax enforcement have less of an impact where this paper trail is present? If that were the case, we would expect a larger response on transactions, sorry, the opposite of what the slide said. We would expect a larger response on transactions from the firm to the final consumer than between two firms. So think about it this way. If you were evading the same on all transactions, and somebody comes to audit you, then you're much more afraid of the part where there's a paper trail, right? Because now they can audit, they can check. So if all else equal, you would respond more where there's a paper trail, because that's the dangerous part. But if you anticipated that before and you already were not cheating as much on the transactions that have a paper trail, and now the government says we're monitoring you, then the only part that you sort of have left to respond is this part with the final consumer. And so even though audits can more easily detect things where there's a paper trail, you respond less where there's a paper trail. There is a strong suggestive evidence that ex ante you were already cheating less on those transactions. So that's exactly what we find. So we find that the sales to other firms and also the purchases from other firms barely responded at all. And all this big increase that we saw in the earlier slide came from increase in sales to the final consumer. So this sort of suggestive evidence that the paper trail did seem to be highly effective. But now you know how economists are. We like to think about counterexamples and things that are not equal, and we can all come up with 10 stories about why sales to the final consumers are different, or maybe people understood the letter to refer more to that, or many other things. And so the second experiment was more geared towards trying to see, can we actually see the mechanism in action rather than sort of the exposed effect of differential responses. So here we had to go to a special sample where we thought this was not working yet. So we tested this mechanism to see whether we can indeed see the spillover from me asking for a receipt from my supplier. And so we went to a subsample where we thought evasion was actually likely to still happen even in transactions between firms. And the tax authority announced an upcoming audit to half of the sample and didn't tell anything to the other half. And then we tested whether announcing an audit would actually affect not just my tax payment if I received this notice, but my supplier's tax payments as well. And indeed, we did find that. So we found that when I receive an announcement that I will be audited, then the firm that I'm buying things from, and presumably I'm now asking for more receipt because I know they're going to check my receipts, right? And so that firm that I'm buying from starts to also declare more taxes, even though their audit probability didn't change. So when the firm starts complying, it creates this spillover effect up the value-added tax. So this was a quick summary. Let me give you a bit more of an explanation. So we're going back to our chain of 3 firms and the consumer. Before we were seeing what happens to the firm 3 and his firm 3 behaving differently to the consumer or with firm 2. But now we're going at firm 3 sort of from the bottom. We want to see either attacking firm 3 or enforcing taxes on firm 3 triggers a spillover effect where then they have an enforcement impact on firm 2. So this sample of suspected or suspicious firms was very small firms in the rural areas. So these are much more similar to maybe your typical middle-income country or lower enforcement environment where there was not too much interaction with the tax authority. And in particular, these firms had a clear risk indicator, which was that they kept declaring losses and losses and losses and losses, but they never get out of business. So either they were very optimistic and always thought, like, next year is going to be the big breakthrough, or more likely, and according to the tax authority, very likely they were actually under-declaring their activities and therefore continuously paying zero tax. So the intervention was that we took this sample of specially selected firms and informed half of them that they, in particular, would be audited in the next 6 months. But then the whole sample was summoned for an audit. And the tax authority had to summon them because in that case, tax authority didn't actually have the books of sales and purchases of these firms. That would only be visible in an audit. So in the audit, the auditors collected information about who the trading partners were of these firms before the treatment. And then we analyzed the tax payments of both the suppliers and the clients of these firms that had received the notice and the comparison firms that were similar but had not received the notice. And so we could compare what happens to my trading partners versus what happens to the control group's trading partners who have not been randomly selected for that information about the audit. And so what we found is there was a big increase in tax payments by the suppliers, and importantly, not by the clients of the treated firms. This is important because you could imagine if I am one of these small firms that is cheating a lot in the middle of nowhere, and I get a letter from the tax authority saying I will be audited, that the first thing that might happen, we all think, oh, there's a new strategy, they're now auditing small firms in the middle of nowhere, and so I tell all my friends, and we all start paying more tax. But it's very important here then that there's this distinction that what happens is not everyone that I talk to starts to pay tax, but only the people that I ask receipts from. So I get audited, I want receipts because I need them for the audit, then the person upstream from me needs to declare more sales, and they pay more taxes. So it's exactly, sort of, we're jump-starting the self-enforcing mechanism by injecting deterrence into the system, and then we can see how it goes up the chain. So in summary of this Chile study is that we're looking at the whole economy in a very well-functioning VAT system. In the first part, we increase the perceived audit probability, and we see that it has less of an effect where the paper trail and self-enforcement is present. So the self-enforcement in this sense acts as a substitute, so the government doesn't have to audit as much because firms are so afraid of being audited that they already comply in anticipation. So the paper trail in this case really facilitates tax enforcement. But then we're already getting a hint that the caveat of what's going to happen in Ecuador is that we show that it's actually not self-enforcing as the word may suggest, because it clearly was not working in that specially selected sample. So it was only the announcement of a pending audit that actually led to this spillover, and suddenly this thing started kicking into action, and so it was triggered by deterrence. And so it's really the interaction of deterrence with information that led to this effective enforcement. Which exposed, I mean, if you think about it, it makes sense. I mean, just because information sits somewhere, we all know as academics, just because we write a paper doesn't make a policy. And similarly, just because the tax authority has information doesn't make enforcement. So you need both. You need to have this credible deterrence for people to actually be worried about the information that the government has. So some of the implications is that we did see that the VAT can exploit the structure of the VAT chain in a really clever way to facilitate monitoring and increase tax compliance. This suggests that taxations that leave a stronger paper trail have an advantage over other forms of taxation. So in this case, it was the VAT compared to the sales tax, but similar things may happen with digitalization, with payments by phone, with payments by credit card, and many other things that leave more traces. But the caveat is it's not self-enforcing without the deterrence to back it up. Here's the additional policy tool that we also developed. We published together with Pamela Castellon, who is in the Tax Authority, and Cristobal Marshall, that we can actually use these letters for an additional purpose. So we sent them. They had a bunch of purposes, right? They collected a bunch more tax from the letters. We learned a lot about self-enforcement, but also they could see what type of taxpayers responds a lot to these letters. And that actually gives us information about where something fishy might be going on. And governments always have this problem: how do I target the audits? The audits are very expensive. Governments have very limited resources, can choose a few cases to go deep. They can choose a bit larger cases to go superficial, but they have to choose. And the challenge is that so then governments many times try to develop some sort of risk indicator, and it's usually based on past findings. So you look, where did we find a lot of evasion in the past? That's where it's risky. We should go there more. But then it becomes very self-fulfilling because wherever you have looked before, you have found problems before, you're going to look more there again. So the challenge is to find more exogenous measures. And so these letters have the benefit that you can send them to a broad number of types of taxpayers, and then you see who responds a lot, and then in that type of taxpayers, it's maybe worth to go deeper. What's important, though, given all this conversation that we're having about deterrence power, is that tax offices don't start to send massive amounts of these letters without anything to back them up. Because, remember how when the Chilean government sent letters, people were responding? We don't want to lose that power. So it's great that the Chilean government still does these, but they're always backed up with reality. There are no empty threats, and I think that's really important. Okay, great. So then, follow-up study with the tax authority in Ecuador. This research collaboration actually started before me with Pal Carrillo, who's here at GW and who has a long-standing research relationship with the tax authority in Ecuador, the SRI. And again, we had long discussions. I went several times. Paul is going every year, and to discuss what are areas of mutual interest where the study could be directly useful to them, but also more generally informative for external validity. And we thought that a campaign that they had already started about third-party reported enforcement would be interesting to evaluate. Again, you can't do these with a very powerful, engaged research department, and a whole number of people over the time have helped with this project. And Andrea Lopez is actually here now at GW and is just about to graduate. So she started as a staff member on the project, and she's now here. It's very exciting. So I want to thank her for doing much of the heavy lifting, and the rest of the team at the Tax Authority. For this study that I think surprised us and also surprised a lot of people in the tax authority, and has also led to a bunch of subsequent changes in the policy. So Ecuador had at the time recently acquired the capability to electronically cross-check this third-party information. So I know some of you are working on this, so for people who are not working on this, it's kind of surprising. It's actually really, really hard to get all that information to sing, if you will. Imagine you have hundreds and thousands of little, receipts or lines in books of sales and purchases, and then somebody has to enter them into a computer, and then you have a computer system with all these transactions, and somehow you have to sync up everyone who bought something from me and add them all up, and that gives the estimated revenue that I had. It's really not that easy. So at the time, Ecuador had this information for a while, but had just acquired the capability to use it at a large scale. So they had used it on a point-by-point basis when there was a particular audit. They collected the information for that particular firm. But here they could do it massively. And so the research questions at the bottom of this is, will this third-party reporting, when you introduce it, electronic cross-checks, and everyone's very excited about it, solve the enforcement problem of developing countries? So if I say the question in that way, you can already guess that the answer is, as always in development, is not that simple. If something starts to sound like a panacea, we should always become suspicious, and this is no different. So here what happened. So the tax authority collected information from the value-added tax that we had seen, like in the Chile case, all these receipts. In the Ecuador case, they were actually ahead of Chile in the sense that all the firms above a certain size already sent all these lists of purchases itemized to the government. So they had more information than the Chilean case. They also had newly acquired information from credit cards and a few other sources, and they combined all that to predict somebody's income. And then they looked at that the firms where the information from third parties was significantly higher than what the firm had declared as their own revenue. They took the firms where the discrepancy was largest. In some of these cases, it was really hundreds and thousands of dollars, where the firm had, say a firm said, I had $200,000 in revenue, and the government knew from third-party sources that it's 800,000. So big, big gaps. And so the government notified them and requested an amendment. Okay, so the challenges are, third-party information is generally partial. And the more you're starting out with this system, the more this is partial. And also other aspects of the tax system don't immediately become stronger just because you have better information. So there's still limits in enforcement capacity and the number of auditors and things like that. So will this still work? So here's what the notification said. It was much longer. Every time the tax authority sends things, they have a lot of legal parts. But the key part was this part. Dear taxpayer, name such and such. After careful data cross-checks, the tax administration has estimated that the revenue that firm U received during 2008, 9, or 10 fiscal year is larger than the reported revenue on its corresponding corporate income tax return. And then there was a line that says, here's what you declared, here's what we know. The tax administration urges you to submit an amendment. Okay, so what happened? So a large share of firms did not respond to the message. Second, firms that did respond increased reported sales. Great, and that's what the government was hoping for. Second part was not so much what government was expecting. Costs also went up by a similar amount. So the tax collection went up for 2.3 million. So 2.3 million is not nothing, right? So Ecuador is a small country. It's much lower income than the United States. So we can build a bunch of schools. You can pay many salaries of many teachers. So it's not nothing, but it's much less than if this was just an increase in $109 million in reported revenues. So that's where, at that point is where we started working together to try to understand what's happening in this puzzle. So we conducted an intensive series of focus groups and qualitative interviews. Paul and I went together with Andrea for 2 weeks and toured the different offices, talked to tax officers, to auditors, to firm owners. At the time, it was useful that I was at the business school, so it's always good that they don't think you're coming from the government. So how do you deal with tax burden? As a business school professor, I want to see how you can help the firms. So they told everyone was very honest. The tax lawyers, we paid them to give us advice about how to avoid the tax. It's very convenient. And so there was actually a consistent picture that emerged, which was that firms perceive that their audit probability is higher if they have a low declared profit rate. Right? So if you are a big factory and you have $2 million in turnover and you have $100 in profits, that is very suspicious. Instead, if you are a small shop and you have $100 in profits, that's not at all suspicious. And so firms try to actually target a particular profit rate. So what does that imply? That implies some firms may underreport not only revenues but also costs, because if you say I want to say I have $1,000 in profits. Well, I want to declare those $1,000 in profits on a small as possible revenue, so it looks like a very big profit rate. And so at some point, I don't want to report higher costs than revenue, so then I'm going to start to also underreport my costs. And so overall, I'm just now looking like a smaller firm, and I can sort of fly under the radar of the attention of the tax authority because I now look on paper like a small firm with a large profit rate rather than a large firm with a small profit rate, with having the same amount of profit. So we thought about how to put this a bit into a conceptual framework. I'm going to try to give the intuition of it. So we think about what does that mean, that setting combined with third-party reporting. And by the way, I think this is very common, that tax authorities look for suspiciously low profit rates. We saw in the Chile case too, they select the firms that had losses, zero profit rate, or negative. But the idea that you think it's suspicious if somebody, given their size, pays very little taxes makes a lot of sense. So what does that mean in combination with third-party reporting? So third-party reporting about revenues makes the detection of underreporting of these revenues more likely. And so Henry Clevin and co-authors have a paper where they sort of formalize this to say you have two types of taxes, a type that is self-reported, a type that is third-party reported. When it's self-reported, you can easily cheat. When it's third-party reported, it has a very high detection probability. But the limit of that is if you have any margin that is not third-party reported and you have complete freedom, you can completely offset, with the other margin. So say I had a W-2 form that says I had a certain income, then I can't underreport that income, but I could, if I can say then, but on the side I have a small startup and it makes big losses and I can compensate that and nobody can check the losses, then I can always get to zero taxes again or lower taxes. So there's this offsetting problem. And in the case of the corporate income tax, that is very particularly the case because corporate income tax has revenues and has costs that you can deduct. And so then firms could use this non-third-party reported part to increase their deduction. Now, the first reaction might be to say, what? But let's just have third-party reporting on costs, and it's fine. We have both margins. But actually, in the nature of the thing, there is an asymmetry. Because third-party reporting helps you to put a lower bound on things, right? So we had this situation where the tax authority collected all this information to see what the firm has in sales, and even if that is incomplete, say they find we had in the example before, they find that the firm had $800,000 in revenue. Well, maybe the firm had 1,000, but if I report 200,000, then we can say at least it's a lower bound. You have to declare 800,000. But notice on the cost, the lower bound is completely useless because I'm going to try to over-report costs. And so having a lower bound doesn't, unless I am sure that I have completely all the costs in my third-party reported amounts, I can't use it to enforce an upper bound on anything. And so there's this real asymmetry in using third-party reporting for costs. So there are some predictions that come out of this framework. We have already seen some of it. So before you introduce third-party reporting, if you have this kind of setting where firms try to have a low profit rate, then first you'd see, in terms of revenues, all over the place. You might find firms that report revenues higher than the third-party reported amount because we know third-party reporting is incomplete. You might find other firms that have less because nobody's afraid that the government's going to use this because they can't use all that information. And so you find them both above and below the third-party reported amount. And then, more surprisingly, we'll find firms that actually underreport their costs, which is very counterintuitive because in taxation you think you don't take all the deductions you can, right? And why would you leave any money on the table? And in this case, you might leave money on the table because you want to avoid the audit probability. Then we have some predictions what happens when now the government starts to use this information to try to enforce taxes. So what happens after these firms now receive a discrepancy notification saying that the government knows that they underreported their revenue. So now they have a much higher enforcement risk on the underreported revenue. So first thing is a higher enforcement risk is not 100% enforcement risk. So even many of you have worked in government, in environments where the government has very limited capacity. And so you can imagine just because the government knows something doesn't mean they have the capacity to do something about it. In particular, Ecuador is quite a developed economy. It's a very powerful tax authority. But even they can't do 8,000 audits in 2 months if you send many, many letters. So the first step that somebody might do is just like wait and see if the government even has capacity to do anything to follow up. So if there is any cost of amending, you might just wait and not do anything. But if you actually then amend, then you're going to amend all the way to the amount that the government said. Why? Because if you do amend, so you have the fixed cost of amending and going back and getting all the books together and finding your receipts and hiring an accountant and all that, you don't want to be still in that range where the probability that they're going to follow up is high because you're still below what the government says. So you sort of either do nothing or you go and you bunch above that amount where the enforcement probability now reduces a lot. So the prediction is that you would see some firms don't respond. If they respond all the way. And the third part is that they may now use their costs to offset some of this increased in reported revenue so that to not increase their taxes as much. Knowing that if the government wants to now come and say that their costs are fake, they now need to go audit them. And that's exactly what supposedly this third-party reporting was supposed to avoid. We could send letters, it's sort of self-automatic enforcement, and we don't need auditors. But if you have the cost problem now, suddenly you're sort of tempting the government to say, okay, you want to audit me, come audit me, but we know that's costly. So then that would be the third prediction. So what did we find? So in the cross-section, without firms receiving any discrepancy notification, first of all, we see confirmation that indeed information is incomplete. So 24% of firm filings report revenues below third-party reported amount, so they're not afraid of that. And a lot of firms report revenue above the third-party reported amount, so clearly what the government has is far from everything. But then the more surprising part is that 23% of firm filings reported costs below what we know they had from third-party reporting. So they're leaving receipts on the table. Then you could say, okay, some of them have, as in many countries, most firms pay no corporate income tax. So if you have no corporate income tax, you might just not bother declaring all the deductions. But we have 5% of firms who do pay taxes, positive amounts, and still have costs that we know of that they don't declare and they don't take the deduction. And we know that is an underestimation of that behavior because we know that the costs data is very incomplete. So this clearly seems to be happening, that firms strategically underreport their costs. So now that has a problem that comes with it, because if I don't receive, you remember I asked for a receipt, next guy is going to pay taxes, they ask for a receipt. It's very nice, but if I now say I don't need that receipt because I want to sort of pretend to be small anyway, so I'm now not asking the next guy for tax. Now there's less information about the next guy, and all the thing unravels, right? So this underreporting cost was really not sort of considered when thinking that this would be self-enforcing automatically. So then they did this policy intervention. They had 3 rounds of these discrepancy notifications, informing the firms that their reported revenues fell short of the amount that the firm had, that the third parties had informed the government. So they sent them in 2011 about tax years that were already over. So all the response we see is purely reporting, no more transactions are happening. And they sent over 7,000 notifications, a lot of notifications. In 2008, they just said there's a discrepancy. In 2009 and 10, they actually gave you the specific amount. So what happened? So first we said large share of firms did not respond. Those who did respond responded almost all the way when you gave them the amount. So what first in 2008, on the right-hand side, you see that when the government didn't give them the amount, firms underestimated how much the government knows. They undershot. They did amend. When they amended, they only amended about a third. The government had hoped that people would overestimate what they know, and therefore purposely not giving firms the amount, hoping that firms would go beyond what the government knew. But this is maybe a good measure of deterrence power. People underestimated. So then in 2009 and 10, the government did tell firms, and then firms went over 90% all the way to the amount that the government had indicated. And in fact, if you see, like the most of them went to the exact same amount. So you see this bunching behavior. There's a bit more just above than just below, but the half of them are exactly at that amount. Then the cost adjustment was even more extreme. So we had over 90% of the amount that the government said you had in revenue the firms adjusted to, but we had almost 100% of the increase in cost was compensated or offset by an increase in reported. The increase in reported revenue was offset by an increase in reported cost, which led to a very limited increase in tax collection. And in particular, it looks like some of those costs are probably real because we know firms have underreported costs, but some of those costs are probably not real because we see the line items that go up the most are the ones that are hardest to audit. So the most popular one is other administrative costs. So that's very suspicious of evasion behavior. And overall, what happened is the revenue of the average firm who did amend went up by over $80,000, which is a lot in the Ecuadorian context, but the costs also went up by $80,000. And so the tax liability increase for the firms that did amend went up by $1,850. If you take into account that a lot of firms didn't respond, it's only a bit less than $300 per firm that they actually paid in additional taxes. That was much less than the government had anticipated when they first sent out these mailings. So what are we taking away from this? First of all, introducing this third-party-based enforcement did have an effect, and the discrepancy notifications did increase declared revenues in the first instance, but the effect was very limited because firms could adjust on other margins. So particularly when information is very incomplete, there's going to very often be other margins that firms can adjust with. So to be more effective, if possible, where there is a third-party-based system, it should cover the full tax base, so all parts of the declaration. In the value-added tax, that's much easier because there aren't these special deductions in other parts. But there's also an argument sometimes made in favor of a turnover tax in particular cases, even though that has efficiency problem from economic perspectives in other ways, but because it doesn't have that offsetting potential. And then other implications, if you want to analyze the impact of an auditing program, it's just that if you find no evasion on some third-party reported element or on some after an audit or something, it doesn't show the entire impact. It's very important. You need to look at the global effect on the whole taxpayer. I mean, you might see that you enforce more on one activities and they're cheating more on another, and if you don't measure that, you might overestimate the effectiveness of the reform. It's very similar to the literature on crime displacement, where putting a policeman on a corner and then measuring crime in that corner is not the global effect of that policeman there. The next corner over, it might also be important to monitor. Or there's a whole literature on multitasking of incentives that's very related to that. So what are some implications of this? So I think what the implication is not is that third-party reporting is useless. It's not. But it's not as easy as switching on a light bulb. So there's some benefits even in the Ecuador case that were happening despite the fact that per firm that received this notification, the additional yield was not that high. For one, it allows the auditors to focus more on the non-third-party reported activities, right? So now on the cost side, you can send more auditors because on the revenue side, you have the information. So that for sure makes one auditor more effective. And also you have some firms that do comply, they see this, they pay up, maybe next year they comply ex ante, and so you can focus on those firms where you have the discrepancy. The other thing is that this is a first shot, right? They sent this one time. This is not what it's necessarily going to look like in steady state. You can build up an effective system probably in a dynamic process, but it takes time. There's two mechanisms in that. One is, if you remember, like this cost offset, right? We saw that some of these costs were probably fake, and some of these costs, they probably still had receipts because they were underreporting. But some firms might gonna say, okay, next year I know that they're gonna know more about my revenue. I want to have correct receipts, and now I'm gonna start asking for more real receipts. So now what happens? Now I'm gonna ask for more receipts. There's now more information about the next guy, and then now the next guy is gonna ask for more receipts. And you can imagine this network of information sort of spreading as more and more people want to take the cost deduction. As the same way I was saying, when you don't ask for receipts and you don't report the cost, the thing can break down. You can imagine you're building it up by saying, okay, as in the Chile case, the more I enforce a downstream firm, the more they're going to ask their supplier for receipts, the more information you're going to have about the suppliers, and more firms are going to be subject to these third-party reporting on the revenue side. The other thing is they did this in a very big one-shot 7,000 firm intervention. And one might imagine doing this more gradually so that it's credible that the government is going to follow up with you if you either don't respond or you respond in this crazy way where you have now, $200,014 more in revenues and $200,014 more in costs. And this looks very suspicious, but nobody has the power to follow up. So one could imagine you go and you say you do this for 50 firms. And every single one of them who either doesn't respond or responds in a suspicious way is going to have auditors in their door next month. You can trust that your tax accountants do talk to each other. You can trust that that information gets out, that that type of notification is serious. So when you send this same notification next year, maybe to 200 firms, you probably still have the same small group of firms who don't respond because you have like 150 or more of them who will have heard that this is a serious one. So then you have 200, but you still have a small number of cases you have to go audit. And then you can build it up. And essentially, if you think of rich countries, it's not that rich countries have that many more auditors. It's just that we're in an equilibrium where most people are so terrified when we receive mail from the tax authority that you don't have to send auditors. So you want to build that deterrence power gradually and not send any threats that you cannot back up so that then you can, in the medium run, send more threats. Overall, it's kind of like auditing and third-party reporting or information complement each other. If you have more information and more deterrence power, then the deterrence is worth more with the information, and the information will be more effective in deterring evasion when everyone knows that if there is a discrepancy, something is going to happen. So it's a bit like in the O-ring theory by Michael Kramer, where the weakest link matters, and if the weakest link, is not reliable, everything falls apart. So it could be another margin. You have third-party reporting on revenue, but not on cost. It could be that you have great third-party reporting and information, but once the auditor is in the house, you can just pay him a little payment on the side, and who cares what the central government knows? It could be you don't have the capacity. There's all these additional aspects. And so I think the bottom line is really that even though third-party reporting is important and electronic cross-checks are important, developing countries still really need to strengthen their very traditional auditing and enforcement capacities as a complement to that information. So taking a step back, so what are some of the big takeaways? We started out by saying limited information about taxable transactions in the economy is a very big challenge for developing countries. But obtaining that information, while very, very important, is not sufficient. So self-enforcing is really a misnomer, because without credible deterrence, all the information is not going to fix things. So third-party reported information can play a very important role for tax collection, but there is no quick and simple fix. It's important to gradually build up the process, both of the web of information and of deterrence power. And strengthening traditional enforcement capacity remains really important. So to conclude, I wanted to just tell you where I see a bit this whole area of research going. I'm very excited to hear that in the bank there's going to be more research on this and more collaborations with governments. I think it's a really very promising area with so much more data becoming available, and also an area where it's really win-win, because as you do the studies, government is already collecting more taxes, so there's a lot of things to be gained for both sides. So on the one hand, it's really going more deep into this auditing capacity. So we have a paper more on procurement, but it's a very similar situation where it's how do we even design the audits? When I started to work with auditors, I realized almost everyone who works in auditing is a lawyer, and lawyers are fantastic and really great, but they are not traditionally trained in thinking about incentives. They think about rule compliance. A lot of times I ask, why do you do it this way and that? And people sort of stare at me blankly and say, because it's the rule. Like, what's the question? Which is great, because you don't want corruption, so you want people to just follow the rule, but in the design part of the audits, you really want to think about incentives. And what we found in Chile is that there are certain types of audits that produce the exact opposite effect of what they're intended to do. So I think there's a whole area of research that I hope economists are going to get more excited about. And the other area is sort of, we were talking a lot about deterrence and punishment and information and how to get these evil taxpayers to finally comply. But the other side of this is, can we make it easier? What can we do to make it convenient to pay the taxes? And one area that I'm just starting to work on with Lorenzo Casaburi in Kenya with the KRA is to think about, what about timing of taxation? You know, the models in classical economic theory are all about how does the tax affect your profits. But if you think about developing countries, it's not just about the profit, it's about your cash flow. It's when do you even have the money to pay the tax? And if the tax comes once a year or once a quarter in a time when there's a season where you have very little money on the side, it's really costly for you to pay taxes, even if had that come at a different time, it would have been much more convenient. So the whole area of how can we make tax more adjusted to people's needs and abilities so that they can comply if they want to. And the third completely separate area where I think it's also interesting for the bank is you can't only study tax with tax data. Tax authorities are in the business of collecting information, as we have talked about the whole hour today, and so they have a lot of really great information. So for example, from this value-added tax, with all these receipts going back and forth, you can actually construct a whole network of all firms in the economy. And so then you can use that to study what happens to economic shocks, what's the impact, what are the spillovers, you know, if the bank has some program in one region, does that spill over to the next region? All of these things in principle are hidden in that tax data. And I think there is a whole, I think is going to be a whole field of research that's going to emerge from that type of data that we haven't even started to see at the beginning of this. So all of this to say, as you can tell, very excited about collaborations between researchers and experts from tax authorities. And I have learned so much from working with all these experts from practice. And all these things I learned from them. And I think it's really worth it to sit down together and to do projects together, not just I go there, give me the data, I'm going to go home, but really design the projects together so that we answer questions that are of direct relevance to them. And that, in my opinion, also makes the research more interesting. So to conclude, I'm very thankful for the SRI and the SII for having made these collaborations possible. And maybe thanks to this research, we will have less taxpayers who tell the auditor that the dog ate their receipts. So thank you very much.
Thank you very much, Tina. So now we turn to you for questions, comments. Please come to the microphone because we're streaming. Oh.
Thanks for that really informative primer on taxation and also on the sort of third-party enforcement mechanisms. I learned a lot. I wanted to ask, in as much as it's a primer on taxes in low and middle income countries, What would you say about progressive versus regressive forms of taxation? Some of taxing in these countries harkens back to colonial tax policies. And in a sort of OECD context, we talk about progressive versus regressive. So as we think about expanding the set of people or firms or activities that are taxed, how do we approach the sort of welfare questions that accompany that? Thanks.
Dina, so besides like understanding if you penalize a firm or audit a firm to pay more taxes, what do we know about fiscal transparency, especially in developing countries where like usually like taxpayers don't really trust how the money is handled? Is anyone looking at what incentives, if I see that in my community there's more transparency with how the budget is being handled, are firms, you know, like more likely to pay their due part?
By fiscal transparency, you mean like transparency of spending?
Exactly.
Mm-hmm. Mm-hmm.
It was a great presentation. I couldn't help but wonder with the two taxes that we're studying, these two different pieces of research. I mean, with the main difference between the corporate tax base and the VAT base would be the payroll bill. So I was wondering if there's some work being done on just how you would use information you have from your VAT collection for collecting better the corporate income tax.
Okay, I think I'm gonna start. Otherwise, I'm gonna run out of memory space. Okay, so for the progressivity, I think it's a very important topic, and I think it's just important to keep both parts in mind. So sometimes, from all the excitement about expanding the tax base, we forget to think about what that does to distribution. And I think it's very important to keep both aspects in mind. On the other hand, it's also interesting to see that when people do make a little contribution, they feel like they have more rights to ask for compliance from the government. So there might be a vision where you think everyone should pay something, but it shouldn't be disproportionately fall on the poor. And it's, I'm sure, an area that we haven't been paying enough attention to. On the fiscal transparency, it's a question that I'm very interested in. It goes a bit into this area of push versus pull factors for compliance, right? Making it easy in terms of timing, but also making it motivating because you think it goes to a good place. There is some research showing that when there's sidewalks being constructed, then maybe taxes go up and things like that, but I think it's an area where we should know much more about. So anecdotally, I can just, when I was in Kenya, I asked everyone I sort of ran into what they think is the biggest problem with tax compliance. And what people said anecdotally, everyone said corruption. I don't pay because corruption. So now, would it be enough? Like, what would be enough to change people's minds on that? I don't know, but I'm sure it's a very important concern. On the VAT and the corporate income tax, so they use the VAT data exactly here. But the problem is if you have ways to make deductions that are hard to audit, to check whether you made them up, you have very incomplete data, so you can't say just because I don't have a paper trail, I don't trust the cost, then you will need to send an auditor there, which is costly. So it's a bit of a challenge. One of the reforms the Ecuadorian government did after this finding was just to make it harder to ex post come up with costs. So that once a certain time has passed and you are summoned for an audit, then it's you have to supply more justification to come up with cost than to just say, oops, I just found $500,000 in costs. So they make it a bit harder, but I think it's this gradual process again, that when you have more people who are in the tax net and in the information net, then it's going to be harder to do this offsetting behavior.
Hi, thank you so much. That was very interesting. I have a question about the firms that didn't respond at all in Ecuador. Was there any kind of pattern or any kind of information or a story or theory you have about who they were in terms of whether they were from a particular sector, a particular size, or rural or urban? What kind of questioning and theories do you have as to why such a large proportion of firms didn't answer? Thank you.
Thank you, Dina. So the two examples you had from Chile and Ecuador, these are kind of pretty strong tax authorities to some extent. And I was wondering, how would you characterize the challenges from the very low income countries? So think, very low income.
Thank you very much, Professor Dina. I was also wondering about the stylized facts, like I don't know if within Chile or Ecuador, are there systematic differences, like for instance, specific sectors that evade and how that translates for differences in profitability across sectors?
Can you elaborate a bit more?
Like, I think it's intuitive that firms that evade, could be more profitable than firms that do not evade, but if there's like some hard evidence on this?
Okay.
Mine is more broader. There's so much discussion I hear these days about the global network firms and the appropriate taxation of these companies, and I just wanted to know what your thoughts were on those.
So in international profit shifting of multinational firms.
That and how to sort of, or also in terms of how they are taxed in different countries. Maybe we should.
Yes, I think so. Let me see if the firms that didn't respond. So it's a bit hard in the particular context for us to know which firms did not receive the information versus received it and didn't choose actively not to respond. So we can't completely say, but I think it's a bit related to this intervention of sending this to 7,000 firms in the same year as a new innovation, where word must have gone out that those were 7,000 and therefore can't be that serious because people have some sort of sense what's the auditing capacity. It would be really interesting. We didn't have the time to go more deep and to look what kind of tax accountants do these people have. Are they more informed accountants? Could there be a personal thing of being less risk averse as a firm owner and just say, I'll wing it and see. It would be interesting to study that more, but more deeply, I think not sending out deterrence messages that you can back up will probably convince people not to treat this in such a cavalier way. Yes, I totally agree. So I started working in Chile, and then I continued working in Ecuador, now working in Kenya, and I think it's really important to work in countries where we're starting from a much lower net of tax and information, just because the urgency is so much greater there. But I think there are some lessons to be learned, like this thing about the deterrence. Now in Kenya we're encountering similar things, where if the government has a payment plan and informs the firm that they're supposed to comply, and it's not really clear what's going to happen if I don't. So there's some lessons that I think translate, but it also goes to the other question about tax-based expansion versus justice. Like, how do you even start if you have people who are very, very poor? Do you still want to put them into the tax net? So there's some questions that are very different, and I'm very excited to, I guess, learn more from people who are working in the Kenyan government before having a real expert opinion about it. But I definitely think the work is harder there, and that it also goes to your question about international firms, like how much should this be tax-based expansion, which is very important to broaden the tax base to not have a small number of citizens who have all the burden, but also are there some rich people who are escaping the net and international organizations or international firms, and how can governments enforce taxes on them without risking them to move? So they have sort of this double challenge, where on the one hand you have international capital, but that's very mobile. It's not very deeply rooted in tradition of firms being there for generations that produce, for example, clothing. But then they'll say, okay, I can go to Kenya, or I can go to Ghana, or I can go to Tanzania. Like, what, you really are sure you want to enforce the taxes? So, and then on the other hand, they have very poor people that are also very hard to really hard to tax, and you're not sure how much you want to squeeze people who are already struggling. So I think the challenge there is much higher. So I really admire everyone who works in these tax authorities, and I'm very excited to learn more from them. Yeah, the systematic differences, so that's really the whole game of what tax authorities are trying to do, predict who's cheating. If it's not like if the profit, they use the profit rate exactly as an indicator, as we saw, and then it leads to these then perverse reactions, which is always a game of, I don't know, chasing your own tail, where you have a criteria, and then the firms learn about it, and they try to hide that about themselves. So it's very hard to find out. But that's exactly sort of what a lot of the tax auditors spend their time doing, is trying to predict what is sort of a signal of somebody being more risky. And I mean, this whole machine learning revolution, I guess, is also trying to contribute to that by sort of just simply trying to predict who cheats, because you don't really care why. And you're trying to find who cheats. I think it's an area where actually machine learning could be helpful. I think it's very different in different settings. And for the international firms, I mean, there's one discussion about how big is this even. I mean, I think some of you have seen there's a lot of heated debate about if there were no evasion by multinational firms, how much would it really do for low-income countries? Probably for middle-income countries it's more substantial, but it seems like low-income countries don't have that much international business to begin with, so even if there were no evasion, it wouldn't be that large. But that in itself is already highly contested. And then, as you know, there's all these debates. I think Gabriel Zuckman is doing a lot of work on that, in sort of how should we think about taxing those firms, because now we have this system where you're supposed to treat your subsidiary in other countries if it were a completely different firm, and tax them as they were completely and price them as they were a completely different firm, and they pay taxes in that country as if they had nothing to do with the other firm, which is like a horse race between auditors and tax lawyers, and auditors and tax lawyers, and the auditors become tax lawyers, and the tax lawyers become auditors, because the only people who still understand all this are the people who have worked on the other side before. And I have no concluding opinion yet on it. All that I can say, it does seem to get more and more complex, and I'm not clear that there's more and more compliance with it. So it very clearly helps the profession of people who are working in this area, and it's not yet clear to me if it helps for tax collection. So I think we should seriously consider alternative models that are not taxing on where is the labor force or where are the consumers. The problem is, it's always this, there's no panacea for the poor countries, right? Like, so then you're in a negotiation in the international arena between, okay, now you want to have a new system. How is this going to be based? If you're paying taxes where your consumers are, it's going to be mostly in rich countries. Is this where your capital owners are? Is this where your labor force is? And depending on how this apportionment system would then be defined, a bigger or smaller share would be going to low-income countries, and I'm not that optimistic that the conclusion of that negotiation would be mostly in favor of the countries with the least power. So whether or not such a system, there's two questions that are separate. One is, would such a system lead to more tax payment by international corporations? There, I think there's good arguments that it might. Would it lead to more taxes for the least economically powerful countries? There I'm a bit less hopeful, but I'm doing a project right now with the Chilean tax authority trying to evaluate the effectiveness of their reform in monitoring more this transfer pricing regulations, and at least in the preliminary results suggest that it at least didn't have any huge increase in tax collection, even though it had a huge increase in compliance costs for the firms. But I think it's an area where we need much more research.
Any final questions, comments? Yes.
Yeah, thanks, Dina. Nice to hear you talk.
Good to see you again.
So my question is so more like a comment, because I think that both your results, the one on the VAT and income tax, are quite consistent, because in a sense, you know, it's basically a value added. And so if you enforce sales, then it means your cost is somebody else's sales, so that is also enforced. And therefore, you know, your value added would largely be the same, except for a small margin. Now, I want to share with you one example. I mean, one of my India introduced the GST, so my cousin has this company. So I said, how is tax evasion after the new GST? Because they have now imposed, at least for some time, invoice matching.
Okay.
So everybody's sales, you have to mention the ID number of every person you sold to, except final consumers, and every purchase you've made has to be reported again with the tax ID. So essentially, you can create people's profit and loss accounts, except of course the missing piece is if you buy from if you buy from non-registered agencies or you sell to non-registered agencies, which is the problem, which is why the VAT base and the income tax base are different, because of these consumers who are not VAT registered. So so now that they impose it, is very, very onerous requirement, but then you know all the information of the companies, of every business. But then they had a hard time implementing it. That's a different thing. And I think last month they actually abolished it. So now it's back to self-reporting. So he said, oh no, that's fine now. We just do 60-40. So I said, what is 60-40? He said 60% would be all reported sales, 40% unreported sales. But I said, how is it possible? Because you need to also deduct if you're doing 60-40, you're going to have the effect on your suppliers, because they're also not able to deduct what, if you claim something, then it's all automatic deduction on the other side. So it works, it's all linked. He said, no, everybody does 60-40. So it starts from the base. So it says the retailer who is basically selling to the final consumer, he says, he's the one who demands this 60-40, because he said, I'm selling to final consumers, I'm doing cash sales. It's going to be 40% cash sales. So he'll ask the suppliers, you have to do a 60-40, otherwise I'm not buying from you. And they demand the same. So if you're in between business, your margin is only the tax portion, the value added, times the tax rate. That is the difference, which you actually see that some people there. So if you push up their reported sales, you'll push up the reported purchases.
Yes,
and
exactly.
All down the chain.
Exactly.
So it's the weakest link is the final sale, and that's where the biggest problem is.
Exactly.
And of course, they tried a very draconian measure in India. You remember? I hope you know this. They just abolished all the cash and they just said everybody has to put the cash back in the bank. It created more problems, actually.
Yeah.
Tax compliance hasn't increased. It's back to normal now. Anyway, thank you.
Thank you. That's a great illustration of exactly of that mechanism.
Yeah. Any other comments, final points? Yes.
Yeah, regarding also the link and the consumer part of the link, there are some countries that have tried to introduce automatic rebates of some part of the VAT.
Yes.
To allow that without introducing an extra hassle to the consumers or anything like that.
Yeah, Brazil, for example.
And Colombia.
Korea also.
And Colombia, although they ended up abolishing it because it didn't give the results that they wanted.
Okay.
So do you have any insight towards
Yeah, so John Naritomi has a paper on this system in Brazil where it worked apparently really well. It would be really interesting to understand why in Colombia it didn't work so well. She does find that it actually had a big impact, exactly as James just described, that it had this ripple effect up from the consumers. I think the paper is called Consumers as Tax Auditors, exactly because they now have an incentive to ask for receipts. In part, you get a rebate back, and in part, it's like a lottery ticket. Automatically, every receipt enters into a lottery.
In the case of Colombia, basically, it had to be electronic, so they had to be.
So that is a constraint to Oyebola's question. If it's a very low capacity environment where people don't have electricity, then requiring an electronic machine is already a problem. I mean, Colombia is much more developed than that. But I mean, all of these things are very complementary to each other. So it will take time, I think.
Well, thank you very much. Please.
Thank you so much. It was super interesting. And if people have more questions or comments, I would love to learn from your experiences. I'm around. Thank you so much.
Thank you.
Thank you so much. So many more familiar faces.